war, interestingly, doesn't have the huge effect on the overall direction of the stock market. A lot obviously has happened. The world is now at war. Interesting. Just a week ago, we're watching the markets and we kind of understand that interest rates are going up. There are problems in the world, of course. We see the dollar getting stronger. We see the stock market going down. Along comes Poly being a war. A war started in the Middle East, an interesting motif, and markets have responded accordingly. So the main thing most people know when a war breaks out is to, for example, buy defensive stocks, buy US bonds, and buy any kind of maybe consumer staple. That being said, those are the things that were bought. US Treasury bonds were bought. Here comes a chart of that right now. I think it's already up on the screen. If you guys can see it, we're looking at a picture of the 10-year note futures. This little tiny movement, this little baby movement right here, if you could see the mouse, is how the market has responded. We moved on the 10-year note from 4.8%, which was the high, literally last Friday, to today, just 4.62% at the close of the day. So we have lost, the interest rates have come down on the long-term bond by 18 basis points. Federal funds has not changed, but long-term bonds, the 10-year bond is a standard, have definitely yields have gone down. But they have gone down, this is a 30-year bond, they have gone down from brand new lows in price, which means highs in rates. And this movement here is minuscule. In correspondence to that, the Dow Jones has rallied about 600 points from the low of last Friday, where we actually rallied, and we've gone up 600 points since that time. And so that is rallied because rates have come down. Another interesting thing to note is the NASDAQ. The NASDAQ has also had a nice little rally, again, because interest rates have come down. That affects the NASDAQ even more. However, I think that's pretty much it. The short-run effects generally can be down, but long-term, the stock market does go up. War, interestingly, doesn't have the huge effect on the overall direction of the stock market. So putting war aside, what is the information that we have gleaned from a very small rally in stocks, a very small decrease in long-term interest rates since last Friday? Nothing. This is normal movement in the markets, especially when it comes to the bonds. The bonds are literally the critical issue at this point. The market is following the 10-year note step for step. When you see a longer trend like we have seen here, this, by the way, is the beginning of the COVID trend. This was the COVID high of March of 2020 up here. If you could see it on the screen, there we go, right there. After then, the highs were put in, which means that interest rates were literally, that's where you got those cheap mortgages under 3%. But since then, the interest rates have gone way up. By the way, literally one of the worst movements in interest rates in over 200 years, over such a short time period of 3 years. This means that this little blip is nothing. It is not the beginning of some huge move up that will carry the stock market with it. Interest rates are still going to go higher. It needs to get the fear of the bullets and bombs that are dropping elsewhere in the world out of the way before it will likely resume its direction to higher yields. I expect the 10-year note to be literally over 6% at some time next year. That is an increase from here of about 1.4%, and that means it's an increase of around 23 or 24% higher over the next year. That is a serious move in interest rates. Those kind of rates will, of course, pull the stock market lower if that occurs.